So we talked about being house poor, right? And, decisions that people make about purchasing homes. And we've talked a lot about specifics about structures of mortgages, things people can do to qualify.
Yes.
And you and I talk about a lot of other things on the phone when we chat around, just like the decisions that people make, right?
Yes.
And, one thing, this is kind of to bridge this gap of talking about that when we talk about what's happening with interest rates and what's going on with a buyer's, what I would call their purchasing power or their buying power, and how rising and falling of interest rates impacts that. Now, I'm not saying that people should wait and hold off on making decisions based on where interest rates are heading, but at the same time, it's something that they should be aware of. So, we've heard of things like the 1%, 10% rule, which is an approximation, which, basically says for every 1% rise in interest rates, a buyer's purchasing power on average, depending on the price and other things, decreases about 10%. What would you say about the fluctuation of interest rates and how that impacts people's purchasing power and what they should watch out for?
Well, I don't usually look at it that way. Okay, this is how I look at it. Around here, say the average loan amount is, $400,000. Okay, and rates went up, 0.5% at the beginning of 2018. So the average mortgage payment went up about $200 a month. That's the way I look at it. So $200 a month, if you're buying a $400,000 house, if that's going to impact your ability to afford that house, then you shouldn't buy it. Bottom line. $200 a month. Because let's face it, we all throw away $10 here, $50 there on, stuff that makes you happy. I'm not saying you shouldn't. You want your Starbucks coffee every day for $5, or, you like to go to Best Buy and buy gadgets. So we all spend money that is, that we may not have to spend. And that's the way I look at it. $200 a month on a $400,000 mortgage, that should not impact your decision whether to buy that house or not. That's how I look at it.
Yeah,
And,
I think what I hear you saying, and I agree, is that if you're already worried about a fluctuation of an interest rate, you're probably pushing the borders of your own personal finances, and you should maybe step back and think about that. I mean, when I purchased my home, interest rates went up during the time because it's a new construction, so we had to wait. So it was like, how long do you lock? And
Yes.
interest rates did go up, and we ended up getting stuck with a higher interest rate. But because we weren't pushing the border and the barrier to begin with, that was no problem. And
Correct.
that's what I hear you saying, which I think makes a ton of sense.
Correct. Correct. Yeah. It's about lifestyle and affordability, and that change in interest rates more than affecting people's ability to afford homes. And I'm not saying there aren't some on the edges that fell out. There were, but it's more psychological than affordable. To me, that's the bottom line.
Yeah.
So,
Well, I agree, especially in the short term. But now if we
yes.
carry that over long term, if people wait long periods of time, many percentages of interest rate changes, all things being equal on the income side, their buying power is going to get impacted.
Correct.
But even that, though, the home prices are going to change too. So
Yes.
there's so many other factors to play in.
Nobody can predict interest rates. If I could predict interest rates, you and I wouldn't be having this conversation right now.
You mean you still
I-
wouldn't talk to me because you would be
I-
sitting in a castle somewhere?
I didn't say I wouldn't talk to you. I said we would be having this conversation right now.
Good point. Good point.
Right, because really what affects interest rates, and people say, oh, the Fed raised interest rates, mortgage rates are going up. No, okay?
Yeah.
They don't have a direct correlation.
Yeah.
There's an indirect correlation, but not a direct correlation. But what affects interest rates is bad financial news, good for interest rates. Good financial news, bad for interest rates. Uncertainty in the financial markets, like this shutdown or war somewhere or trade war, those are bad. They're bad for markets because they create volatility, and that causes rates to go down. And on the other side, the good financial news, like good employment numbers, good retail numbers, they make rates go up. And right now, you hear people say, oh, there's a flattening of the yield curve. What that means is, and mortgage interest rates follow the treasury market. And that's how the U.S. sells its debt, through U.S. Treasuries. The 10-year Treasury is the bellwether. That's where all interest rates come from. So if you look on the front page of the Wall Street Journal, or you just go onto Yahoo Financial News, you'll see the 10-year Treasury listed and the interest or yield that it shows. Well, right now, the yield on the 2-year Treasury is higher than the 5-year. Mm-hmm. That's what we call an inversion in the yield curve, because the shorter the duration, the lower the rate should be. Mm-hmm. Right now, there's only a 0.15% or 15 basis point spread between the 2-year and the 10-year. It should be a 1.5 or 150 basis point spread. So it's a flattening of the yield curve, and that's because many people think that we may be heading for a soft landing or recession in certain parts of the economy. And so you can see is the reason that the short end is the yields have come up is because the Fed raised interest rates. But the long end is showing resistance against that rising in interest rates because of what they're seeing coming in the future in the economy. So clearly there has not been a direct correlation, because rates have stayed relatively low, even though the Fed's raised rates at, 1.5 or a point over the last 2 years. Mm-hmm. Mortgage interest rates really only went up about 0.5%. Yeah. So there's your primer for today.
So if you're thinking about buying a house, don't let the lifestyle and your life changes drive your decision there. Don't think that you can time interest rates to make a better investment.